Welcome. Today is Thursday, July 27th. I'm Jeff Huge, Chief Investment Officer, JWH Investment Partners, and the founder of Alpha Insights. And this is your Daily Five. Daily Five is the show where we basically share five of the most important charts that are top of mind to us in the market these days. And we think we found a few that are of interest. Before we jump into them, let's first just take a look at a couple of side notes. First of all, I wanted to mention that we do publish a monthly investment newsletter. It's available on Substack and it's free to subscribe. It's delivered directly to your email inbox every Saturday, the first Saturday of each month. And the newsletter is affectionately titled Huge Insights, the Big Picture. Therein, we do discuss key macro factors affecting the economy and the markets. And for those who want a little bit more, there's also an option to upgrade to paid for as little as $12 a month, which includes our monthly market forecast and positioning recommendations. Paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication, which details our top actionable trade idea and provides some updated market commentary every Wednesday, in addition to some privileged access to periodic interim bulletin reports as well as quarterly video content. With that, let's jump right into the presentation. The first chart we wanted to talk about was the new bullish extreme that we've identified in sentiment. We've been talking about this for some time with our subscribers, and among the many surveys and basically indicators that represent or illustrate investor sentiment, the NAAIM Exposure Index, which actually illustrates the 2-week moving average of survey responses from professional investment managers, showed its most recent update reached a level exceeding 99% invested to post a new recovery high. That's actually the highest level recorded since November 21st, when the NASDAQ 100 made its all-time high. Actually, the results from the latest AAII poll, that's the American Association of Individual Investors, that's the bottom frame of this chart, that saw the number of individual investors describing themselves as bullish jump to about 51.4% in the most recent survey. That's up from 41% in the prior week. And while those describing themselves as bearish actually fell to about 21.5% from 25.9% in the prior week. The bull-bear spread, that's bulls minus bears, that actually vaulted by 15 percentage points to 29.9%. That compares to negative 42% back at the October 2022 lows. And I would point out that this is the highest level that we've seen since February 2021, when Cathie Wood's ARK ETF hit its all-time record high. This to us really expresses the attitude among investors quite well. And typically when investment sentiment reaches an extreme of this level, it is indicating that we are in the neighborhood of a likely trend reversal. And since the trend has been up, we think this extreme probably marks a nearby top. Let's move on to chart number 2. Momentum has been posting a bearish divergence. This is a negative divergence in momentum. Last week and again yesterday, as the S&P 500 pushed to new recovery highs, our 10-day momentum study failed to confirm the price action, posting a lower high in each case. This was the second significant negative momentum divergence of the year. The first occurred back on February 2nd, which preceded a 10% correction into the March banking crisis lows. This negative divergence signals a deterioration in the rally's momentum. That's a condition that tends to precede meaningful trend reversals in price, and is illustrated in this chart, which goes back roughly 3 years. A negative momentum divergence has attended every significant price reversal over that period. And actually it goes back much further than this. We just are representing the last 3 years because it's easier to kind of see what's going on a daily chart in that short of a period. But the signal actually provides additional confirmation that supports the bearish setup that we believe is being telegraphed by this new bullish extreme in investor sentiment, as well as lagging market breadth and also our Elliott wave count, which we'll get to a little bit later here. Chart number 3. Chart number 3 is an interesting chart that comes from our friend Callum Thomas down in New Zealand from Top Down Charts. Callum illustrates here the seasonality of the VIX, and it's a new perspective on seasonality. We talk about it with respect to market prices, but not often outside of that realm. And what we're seeing here in this particular chart is that the VIX actually, is represented by the CBOE Volatility Index. Looking back to 1990, has tended to bottom for the year in mid-July before rallying to its highs for the year in mid-October. Just given that, the magnitude of the low to high move is slightly less pronounced when you exclude the 2008 data, but the trend remains very, very consistent. And we think that if history is any guide, the volatility index is poised to surge in the coming 3 months. Our expectation has been for some time for the VIX to spike up to its prior highs, which have been in kind of the mid 30% range, but potentially even exceed 40%. That's a level we've not seen exceeded in over 2 years. Let's look at chart number 4. Chart number 4 actually takes a look at the cycle composite put together by Ned Davis Research. What Ned Davis Research does is they take 3 cycles: the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. And they aggregate those cycles and equally weight them to give us a composite of what one would expect the stock market to do using data going back to 1928. And under these circumstances, the blue line represents the cycle composite's expected path and cumulative forecast return for the year. The gold dashed line actually represents the S&P 500's actual path and its actual cumulative return for the year. So, we see in the first quarter, the market got a little bit ahead of itself and really deviated pretty sharply from the cycle's path. But then it resynchronized itself with the directional bias of the expected path in the second quarter and carried really up into its recovery highs experienced today. And from that point, we can see that year to date, the S&P 500's actually exceeded the cycle composite's 2023 expected return by approximately 800 basis points. So, we're up about 19-ish%. And, the market was expected to be up around 10%, 10.5% for the year. And so we're way ahead of schedule in terms of return. Now, the cycle composite's path is expected to top in July. We are pretty much right there where it's expected to top. And then it is expected to turn down and basically go sideways to down into late November. So, based on the cyclical factors that we're observing here in the cycle composite, the seasonal factors in the VIX, the sentiment that has reached a bullish extreme, the lagging breadth that we've talked about ad nauseum for months now, and of course, the negative divergence and momentum, all of these factors together lead us to believe that we're approaching a very significant turning point in the trend of the market. So how should we interpret this? Well, there's 2 different ways to interpret it. And we use the Elliott wave model as our primary model for understanding the path of prices and where they should be expected to go. And based upon our intermediate term analysis, looking at the 2020 lows achieved on March 23rd of 2020 and the advance into the January 2022 high, we observe that as kind of being the final move of a super cycle advance, completing cycle wave 5 of super cycle wave 3. And that the initial decline that we saw into the October 2022 low last year as being primary wave 1 down of a 5-wave impulse pattern that should complete cycle wave A of an ABC supercycle corrective waveform that should be proportional to the supercycle wave 3 advance that actually began back in 1932, a 90-year advance. And so we're looking for something that could last a number of years before it's complete. Now, what we've seen so far is we've seen a rather extended advance develop off of that October low. And we count that advance as a counter trend advance, and we've identified it and labeled it as a double zigzag corrective waveform, which in Elliott wave parlance would be labeled WXY. And that has effectively retraced 78.6% of the decline off of the March 2022 high. And it's fallen just short of the 88.6 or 89% retracement level, which comes in at about 46.67. Now, whether or not we're going to hit that level remains to be seen, but it's our opinion that we're very, very near the turning point. Now, how could we be wrong about this? Well, one way is the market could make a new all-time high, and if that were to occur, then that would invalidate the count that we've labeled our preferred count on the left-hand side of this chart. On the right-hand side, we've put together what we believe is the most likely probability of an alternate count, a bullish count. And the reason that we've labeled it our alternate count is, for one reason, the proportions of intermediate wave 4 are dramatically out of sync with the proportion of intermediates waves 1, 2, and 3. And so, we just don't feel that it meets Elliott's guidelines of proportion. However, if the market were to extend and make a new all-time high, then it's very likely that this alternate count is what is operative. And if that were the case, we'd expect the market to extend to a level of around 52.35 would be our proposed target. This is a much lower probability outcome, in our opinion, than the preferred count, which is the bearish view. Now, one thing that we're thinking about right now is that within this alternate count, the advance into the recent highs today is likely completing a minor wave 3 level, which means that we should expect a pullback. And so it's kind of in concert with all of the other technical indicators and cyclical indicators that we've described. The question is, how deep will this pullback go? Well, we know if it pulls back into the 4100 area, that's too deep because it would enter into the territory of minor wave 1. And that's a violation of Elliott's rules. So we also know that if we pull back below 4,300, it would actually confirm the bear case. And so we think a pullback up to about 43.28 is possible without invalidating the count. However, if we were to break below 43.28, that's S&P level 43.28, a break below that level would invalidate the alternate count and would elevate the preferred count to preferred count status where it resides right now, but it would confirm that. And it would suggest that primary wave 3 down is in progress. Let's take a little bit deeper look at this from a smaller daily scale. The prior charts were weekly scale. And so what we're doing here in chart number 5B is we're kind of blowing up that period from March 29th of last year to present. And we can see it on a daily scale that, the advance off of the October 13th low is a very choppy, overlapping advance. It looks corrective. It looks to be a double zigzag pattern, WXY, and it looks to us that the final wave, this wave Y, which is broken down into an ABC, normal zigzag, has a bit of an extension. And that C wave, we count it out as 1, 2, 3, 4, and then we can count at minute or sub-minuet degree of trend, 1, 2, 3, 4, 5 into another fifth wave. And so what we have is some subdivisions going on here. But what I think is most important about this particular chart is simply that, we're looking at a number of unfilled chart gaps, including the gap between yesterday's close and today's close. And, going back in the historical record, there are very few examples of unfilled chart gaps in the S&P 500 prior to March 2020. Gaps have a very strong tendency to be filled eventually. And it's our view that we need to mind these gaps. We need to understand that, the market can come back quite a bit and fill these gaps. even if we're still in a bull market, or even if this is a bull market, I should say, we could pull all the way back into at least the 40, roughly 45, 44.50 level and fill the last three gaps without, invalidating the bull case essentially. But if we were to pull back below 43.28, that would validate the bear case in our view. And so, we're looking really at that S&P 43.28 is kind of being the level to focus on. A break below that level suggests that the bear case is operative and investors should be on the sidelines under those circumstances. However, if in fact we hold above that level, then there's a possibility that the market's advance could extend higher. And what we would be looking to do from a positioning standpoint is watch this cyclical time frame over the next 3 months. And if we can arrive at, a level that's above 43.28 by, say, late October, late November, in that kind of, say, November timeframe, and we don't violate that level, it might be an opportunity to reposition long. However, if the market does carry below that 43.28 level, the bull case is off the table at that point, and you want to be out of the market. So that's kind of our view, and these are the charts that are helping us form that view. With that, if you have any interest in following up with us or taking a look at our other work, you can certainly go to our website, www.jwhinvestment.com. You can follow us on Twitter at alpha_insights, or you can find our newsletter on Substack at hugeinsights.substack.com. With that, I want to thank you for your time and wish you the best of luck trading. Thank you.